Hello, everybody. Welcome to Friday and another Talk Money with Tom show today. Really excited to have you come today and ask your questions. We already have some questions from this week. You can send in questions at any time, including during the show. And so it's the Ask Tom at talkmoneywithtom.com email address, and just email your questions in and we'll go through them. One of the things that we really focus on in our specialty is retirement. And, retirement is, in my opinion, the biggest financial goal that people have in their life. And if done properly, can actually be, I think, the most gratifying financial situation that they get into. And so that's what this show is about, is to really create investor education, and in so doing should help to create a higher net worth over a period of time, and certainly has a chance of creating a better retirement. And so those are the things that we kind of focus on with financial planning and retirement planning, tax management, investment management, all those types of things. So, really excited. Now, we have this channel, this Talk Money with Tom channel that you're looking at now. And we are constantly putting new content out that would help, people to increase their investor education. So if you want to subscribe to that channel to get notified when we put new videos on, you can hit the subscribe button, hit the little bell, and that'll do that for you and notify you. And if you don't want to subscribe, you can do the email. Just send us an email address and we'll put you on our email list, and we'll send you links when, for those videos when we post them and such too. So really great process. Really enjoy this show so far, and it's fun for us to be able to kind of answer questions and what have you too. So um, what I like to start with for the show is just kind of a summary for what is going on in the stock market for the week. And this has been a very, very interesting week. And so let me share my screen here and I'll go through it with you. So what's important about this week is really what just happened this morning. And this is the jobs report that came out. So this report's for last month, for August, and it's saying there's 235,000 new jobs created in August. Okay. Well, that's a bit of an issue because there was 720,000 jobs expected to be created. And so that's a really big miss. And there's a couple of things that I think are interesting about this. Number one is that normally when there's a big miss like this, that means the economy is kind of falling apart. There's not enough jobs being created and the economy is heading in a downward direction. That's not true right now, and I'll show you why. This is a different time period. And number two, it actually is a very, very important number for the way the Federal Reserve is going to look at this. And again, I'll talk about that in just a moment. But one thing that also did happen, interestingly enough, is that unemployment actually dropped. So even though there weren't tremendous number of jobs created, the number of unemployed dropped down to 5.2%. You can see it was all the way up to near 15% here at the worst part of the pandemic. And if you look here back in 2019, it was around 3.2%. So we're not too far away from what they would consider kind of full employment as far as that goes. But let me show you some surprising things. Only 235,000 jobs were created, but there's a lot of job openings. And so this shows the number of job openings going back to 2000. You can see it drops during recessions, dropped here obviously during, the close, the shutdown that we had during the pandemic. But look at this. This is a record. We have almost a little over 10 million open jobs. That's the most open jobs. And so why are we only creating 235,000 jobs? It's because people aren't taking the jobs. And so there's a variety of reasons for that and what have you. But companies are having to kind of go out of their way to find people. And I found this particular sign here. It's really fascinating. Now hiring. This is McDonald's in Medford, Oregon. 14 and 15-year-olds are welcome, essentially. And so this is what's happening, is not that the economy is growing slowly and not creating jobs. It's that people aren't taking the jobs that are available. So they're starting to try different things. They're moving down in age and taking on younger people and trying to kind of expand the pool of people that they might be able to hire. And so that's been very, very fascinating. And then one of the things that's also interesting here to me is just what is full employment? Right? So full employment, if you thought about it just in as a common sense way, it'd be everybody's working. Well, that hasn't really ever happened. If you look back, here's the employment level, going back to 1950s. And you can see it never went to zero. And as a matter of fact, if you look from the 1970s to now, about 6 million people unemployed is as low as it gets. So we saw that here. We saw it here, just before 2000. We saw it here in 2019. So there's about 9 million people unemployed right now, and 6 million people that, maybe would stay unemployed historically. And so we have some people left that could go get a job, but it is shrinking down. And so that is one of the things that's important. And so one of the ways that they're trying to, attract people out of that pool to come to work is to, go down in age. The second thing is to pay more. And so this shows the average hourly pay wage. And so you can see here it was about 3.6% growth over a 12-month basis in 2019. We had some very unusual spikes during the pandemic. You can kind of ignore those, but we're back to 4.3% right now. So it's a little bit higher growth in wages than what we saw, for example, in 2019. And so this is one of the components that the market is going to look at. So there's two pieces here that are very fascinating. One, when you can't get everybody to come out to work, that could be inflationary. But at the same time, when there are less people coming out to work, the Federal Reserve might stay with their stimulus plans and keep rates lower longer. So these are two competing forces. So if we look here at the inflationary situation, you can see here that the 10-year Treasury, okay, which is a great measure for what's kind of happening with inflation. This is the yield, so what you get essentially out of that. And you can see that the yield skyrocketed in February, March, and what have you. At that time, the vaccine is rolling out. People are expecting, a reopening to happen very quickly. And for a variety of reasons, it didn't really happen as quick as everybody thought. For one thing, we just didn't have enough semiconductors. We couldn't get enough people to come out of their homes to come back to work, and all of these different issues. And now, of course, we have this Delta variant. However, we are now seeing a reestablishment of the increase of the yield in the 10-year Treasury. And so there's a couple things that means. Number one, it means that the bond market might be looking forward and saying that the economy is still going to grow, which is good. We like to see that. Number two is that there might be some inflationary pressure because of that. And that has a lot to do with what we saw today in today's labor report. And so, again, this is not normal. Normally we don't even pay attention to the labor report, to be honest, because it's such a lagging indicator. The people that were just hired in August, those jobs were created a long time ago. It just takes a long time for people to get through the whole process to finally get hired. But right now, it is very, very important to what's happening in the market because of the possible inflationary pressure, how much more are we having to pay to get people to come out, and because the Federal Reserve has very specifically said that they're looking at employment as a measure as to when they're going to start to increase rates and cut back on their bond purchases. So it's really critical right now to focus on these areas. One little quick sidelight here. As you're looking at this, I get asked all the time about refinancing. And so, if you look at the 10-year Treasury, it has a fairly direct relationship to the mortgage rates over a period of time. And so now it's coming back up. Again, if you were going to refinance, if you haven't already, it might be a good time to do that. So, but let's take a look at what's been happening to the market here in the short term and the long term, especially as it's been dealing with this labor issue as far as that goes. So this particular chart is the S&P 500 for the last 5 days. Each one of these little bars is a 10-minute increment. So you can see on Monday, big jump. Tuesday morning, big jump. But since then, we've basically gone sideways, right? And the reason we've gone sideways is because it was waiting for this jobs report. It's very important. It makes a difference as to what the Federal Reserve might do here. But I will say, if you look at today, we're actually up a little bit as this sits, and we're seeing, a decent motion. Again, normally, if you have a big miss on the jobs report, the market would be down because it's afraid of, what might be happening to the economy, sort of a confirmation of what we've been seeing. So, and that's not the case here. The market's actually up because a low jobs report allows the Federal Reserve to keep interest rates lower longer, and allows the Federal Reserve to keep going with, the bond purchase. Now, I will say that August report isn't nearly as important as the September report is going to be, mainly because in August you still had kids at home, so a lot of people didn't come back to work because they had to take care of the kids. You also had a Delta variant that was going up, and you had in some cases, a $300 extra per week benefit that is now expiring in September. So, outside of the Delta variant, which is still here, the other two issues with kids and the bonus for the unemployment are maybe going to be mitigated with schools reopening and what have you too. So it'll be interesting to see if there's a lot more people that come back into the workforce next month. And the Federal Reserve has said as much. They've said that they're going to focus on September and see what happens there, and then maybe make some announcements, more concrete announcements in November at their November meetings as to what they're going to do. But just lastly, this has just resulted in this unbelievable market. This is a very unusual 12-month chart here. First of all, this is each one of these bars now is a day. This is the last 2 years, sorry. And so you can see, what's been happening here is that we had this, giant downturn, obviously, and this amazing recovery. But the last time we've had any type of bigger downturn is really the September-October timeframe. And since the end of October here, this each one of these bars here is a trading day. There's 210 trading days that we have gone without at least a 5% downturn. Very, very smooth upward movement. There's only 7 other times that have had more trading days in a row without a 5% downturn, and we're still going, and it's still happening. This blue line here is the 200-day moving average, and you can just see it's very smooth, and things are going really, really well as far as that goes. So really, really a unbelievable time frame. And to me, this is fascinating how this is all going to work out. What really happens, and what happens along those lines. But what has happened for the stock market is that it's been allowed to kind of stay in this zone. The job growth isn't too high, it isn't too low. The inflation is a possibility, and it might still be a possibility, but it's not really happening yet. And the Federal Reserve has some room to kind of stay where they are. So really, really interesting time frame. So I look forward to kind of talking to you again next week about that for the summary, and we'll see what happens then. All right, Eason. Eason, I forgot to introduce at the very beginning, but obviously he's one of our other advisors here. When your questions come in, they'll be coming into him, and he will be, kind of the moderator as far as that goes. You might ask some follow-up questions and make some other points. And again, we really try to take each one of these questions as much as possible and give you, a well-rounded answer as much as we possibly can with our experience. So let's start with the questions. What do we have first, Eason?
So we have a current event. So this week, it was published that Social Security Trust was going to run out 1 year um, sooner than expected. So 2034 instead of 2035. So what does it mean when Social Security's trust runs out of money? And should I be concerned about my Social Security, or what is that going to happen to me?
Yeah, obviously, we actually got this question quite a few times this week because the headlines came out. I guess last year, because of the pandemic, Social Security collected less. And of course, people are still retired and still, out there collecting Social Security. So the trust, the Social Security trust, which was supposed to run out in 2035, might run out now in 2034. But let me describe some things just so you can kind of understand exactly what that means. There's a lot of misunderstandings of how Social Security works. So essentially, Social Security is a situation where money comes in from people like us that are working and then gets paid out to people that are retired. Between 62 and 70, you can start taking it, and you can take it for the rest of your life, assuming you qualify for it. So what has happened over the last many decades is there's more money coming in than going out. And they've actually been accumulating money. And that accumulation has been happening inside of this trust. So when they say the trust is going to run out, that doesn't mean Social Security is going to run out. And that's a huge differential. Because if you look at the projections from the Social Security Department, even in, when things do kind of fall back down, there's still 80% of the money coming in that needs to be, paid out to satisfy all the requirements that are in the current group of Social Security recipients and the projected group of Social Security recipients. And so it is not that Social Security is going broke, it's that this trust is running down. And so that's super important component. So really, worst case scenario, the trust goes down, they do nothing, they still have 80% of the money to pay out. I think for the next 90 years, the projection I saw from the Social Security Department. Again, it depends on lots of different things. Um, but here's the key thing. One of the things to understand, and I've gone to a lot of classes on Social Security. Social Security has been going out of business since the 40s. If you look at article after article, it must be just fantastic, readership on these things because people are nervous about Social Security. They're worried about Social Security. So you put out an article, say it's going to go broke, and people read it. That's been happening since the 40s. And so it hasn't gone out of business. Matter of fact, the trust has more money as of now than ever, than it ever had. So, it's quite easy to actually fix Social Security in the end. Politically, it's tough. But the way that they've done it in the past is what I think will happen in the future. So if you look, my father got his Social Security, he could get his what they call the full retirement benefit, full retirement age, sorry, was 65. And so now, no matter when he took it, it was 65, and that's an important component. For me, it's 67, right? And so what they did was that in order to make Social Security work better and have more money, and it's worked because there's more money in that trust, they just moved the retirement age, the full retirement age, out 2 years. They've made some adjustments to the cost of living increase, so it's not quite as good as it used to be, but still there. But that's how they do it. And so really, it's pretty simple. Once that trust really starts to run out of money, there will be a lot more headlines, a lot more angst, and somebody will step up and make a change. And so I would expect that younger people their full retirement age might be older, 68 or 69. And maybe the cost of living increase gets adjusted even more for them. Historically, they have never messed with current Social Security recipients, ever. They've always got kind of the deal that they've got. Other than you can make an argument that the cost of living increase has been slightly adjusted, but in terms of their payment, it has continued. And also, historically, people that are very close to retirement don't have any change either. So if you're kind of 55 to 65 range, I've never seen that change either. So this is really the idea is we're going to take younger people and make adjustments as far as that goes. And so, whether younger people get the same retirement age, full retirement age, the same COLA is probably up for grabs. Um, but that's my outlook, because one of the things that does happen is that fear of Social Security going broke clouds people's decisions on when they should take it and oftentimes makes them think that they need to take it right away, even though that could be quite detrimental if they live long enough. So you got to be able to kind of really understand what's happening with Social Security and how it works, and understand that politically they can't let it fail. And it's a lot of money, but the government has a lot of money. So this is something that could be fixed. And there's all kinds of other solutions that they can look at, but just looking at the basics, I think this is something that can be fixed pretty easily, and I think it will.
Yeah, it's good to know that I'm getting a little bit of the short end of the stick with that
Yeah.
deal.
Yeah, I've read some articles for people kind of your age, Ethan, where so my father was 65 for full retirement. I'm 67. I'm a few years older than you, but you might be 69 to get to full retirement age. Now, it doesn't mean you can't take it at 62, and that will be the impact. That means you'll actually get less. If I take it at 62, I'm going to get less on a percentage basis than my father was going to get because he was only 3 years away from full retirement age. I'm 5 years away. You might be 7 years away from full retirement age. So taking it early will be even more detrimental than waiting. But people are living longer. They're working longer. As far as that goes. So, who knows? I mean, my plan is to work till age 75. So it doesn't really matter to me. I don't plan on taking Social Security until 70 unless I have to, unless something weird happens as far as that goes. But that might be true for you too. So it still kind of works out. Theoretically, if you're waiting till 70, you could end up in the same boat. Well, no, that's not true. They're given that 8% per year growth. every year after your full retirement age, plus the cost of living increase. So for me, that's only 3 more years that I get to make that growth. For my father, it was 5 more years, so he could get even more at 70. For you, it's going to be 1 more year. It won't be that big of a deal. So anyway, so there are some ramifications, obviously, to that, and you might get less out of that. But theoretically, you're at a point in your life where you are young enough to kind of know that. And that is one of the things they keep talking about. If we're going to make adjustments, let's make sure that the people that are younger know what's coming, so they can save more in their 401k or IRAs or whatever, to kind of make up for that. Surveys show that most younger people aren't expecting to get any Social Security. They're going to get some Social Security, but maybe that's a good thought process. It makes you save more. Nothing wrong with that.
Yeah. Another thing that we've been hearing a lot, just a general saying that's been going around is timing the market, not timing the market is the way to go.
Yeah. So, um, this is an interesting one. I actually had a client write me this quote not too long ago. So what he's saying is that time in the market is more important than timing the market. So in other words, being in the market and sticking in the market in whole is more important than trying to get in and out of the market as far as that goes. And yeah, you and I, Ethan, were actually having a conversation recently about that. And, so let's say that 2008 came along. I'll tell you a story that I thought was kind of funny. So I was meeting with a client after 2008. Our portfolios were down. The market was down. The total stock market index was down almost 60%. And I think, across the board with most advisors, their accounts were down from those highs. And this lady was talking to me. She said, well, why didn't you get out? And I was like, well, I just don't have that kind of crystal ball. And she says, well, you don't need a crystal ball. You just need to know when to get in and out. I'll never forget that conversation. But what the problem is in terms of getting in and out is, how do you know when it's going down, right? Okay, so there are some people that have gotten out, and there's some famous situations. Although a lot of times when you look at their overall strategy, they're getting out all the time, and they've been wrong the last 20 times, and they were right this time. And so sometimes that kind of offsets what gains they might have made. But oftentimes you need to let it fall some to figure out that it's going down, in my opinion. But if you look at the stock market charts really closely, they spend way more time going up than down. And so you don't have a lot of time to get out, uh, and before it's all over. And you could be wrong anyway. As far as that goes, I'm much more in favor, if you're going to do anything, of staying in. Let's say you have a 60 or 70% allocation, stick with that. Maybe make some rotations in there. So I took a look in the last downturn, and during that pandemic, I looked at what was falling less. And because to me, that meant the market was looking at that as more important and something they wanted to hold on to. And we did some rotations into some of those things, and they did. They bounced back faster, and the market continued to like those for quite some time. So, that's probably a better strategy. That's where you're staying in the market. Trying to time the market, especially that wholehearted in and out aspect, extremely difficult, and probably there aren't a lot of people that have been able to make that work, that I know of.
Yeah, and if you're able to do it, most of the time you're not going to be working after a while. You're
Yeah,
going to be
that's
running. You're going to sail into the off into the sunset, basically.
Yeah, exactly. I mean, if you're really good at figuring out when the market's going to drop, and you can get out at some high or close to high, and then even more importantly, you got to get back in. So let's say you do get out at a good spot, but then you got to get back in at a lower spot. And sometimes, again, you're waiting for that recovery, and all of a sudden you're back above where you got out. You should have just stayed in, right? I mean, because it's not just it's two things. You got to get out at the right time and back in at the right time. Yeah, if you can do that, yeah, you're a big time money manager, maybe, and or you're just sailing around the world in some 120-foot yacht or something, because that's a skill set that's very, very difficult to accumulate. That's for sure. So, and that's why that saying is, you're better off. Time in the market's more important. The market goes up over a long period of time. I mean, we've had two giant downturns in the last 25 years. The market's way up in that 25-year period. So, you know that's the key. Find your risk tolerance so that when those do go down, you don't panic, right? That's critical. Find your, your place in that overall scheme. So, to me, that's how much stock you have. Is it 20%, 50, 70, 100% stock? Find your risk tolerance. Understand what that means, and then try to stay with that amount of stock. Maybe make some small changes when things happen rotation wise inside the stock market, but you still stay there. Right? That makes sense to me.
So we got another allocation question is um, I have a mix of stocks and bonds in my portfolio. I'm getting close to 60. And, as I age, should I change how my allocation is? Should I be more conservative as I get older?
I get asked this all the time, and people actually assume that they should too, and that may not be accurate. So here's what I would say that I think is really interesting. Two things. Number one is when we do our financial plans, one of the things that we do this Monte Carlo simulation. So you're heading into your retirement, or you're in retirement, or you're way away, wherever it is. And so now I got a 60-year-old that's asking this question. And so, we're going to look at that financial plan. We're going to run the Monte Carlo simulation, and we're going to model different mixtures of stock and bond and find the amount of stock that that person has to have to achieve their goals. So that's the first thing. So let's say we run a financial plan, and you've got to have 60% to make your goals work, or maybe it's 20%. So that's the first one. What mixture of stock and bond do you need? So let's just say the plan says 60 and that 60-year-old we just talked to is at 40. Theoretically, the plan says they need to increase their exposure at retirement or now to to accomplish their goals. They need to increase their stock market exposure. So that's number one. Now, but much more importantly is number two, which is just what risk tolerance can you handle? And so you want to understand for all these different amounts of stock and bond, how much you could lose at any point in time over a 1 year period or a 3 year period or whatever it might be. Look back historical. Vanguard has some great pieces where you can take a look at 10 different portfolios going back to 1926. Actually 11 zero stock, 10% stock, 20, 30, 40, 50, and it shows you what's the worst 1 year in that time frame. And so you can take a look at that and say, hey, I'm really comfortable, 10% drop over a year, I could do it. And so that'll tell you, okay, these portfolios work and these other ones that drop 20% won't work. And that's a very simplified version of what you'd want to do. There's a lot of other things, but it is important if you end up in a portfolio. Let's just say, for example, we just said that 60-year-old maybe has a 40%. The plan says they need 60%. But when we look at what that person's risk tolerance is and really get into it, we realize that 60% is just too high. They can't do it. Because if you are in the wrong portfolio with too much risk, when the market falls, which it will inevitably do, you will bail out in a panic because it fell past your risk tolerance. You exceeded your pain threshold and you gave up. And you, of course, did that at the bottom. And so, in order to stay in, you need to find the portfolio that matches your risk tolerance. Now, in that scenario, we need to go back and take a look at that plan and figure it out, because basically we might have to adjust something, when they're going to retire or how much they're going to spend, or maybe they some assets we didn't count, like a house, that maybe they should consider moving down to something smaller or into a cheaper area or something along those lines to try to solve that. Because if that person can only handle a certain level of risk and the plan says more, that won't work. You can't do it. It's good to know. It's important to know what the plan says, but your personal risk tolerance dominates that. You're not going to care what the plan says when the market is falling like a stone and everybody thinks it's the end of the world, and you're falling more than you can handle. So that risk tolerance is critical as far as that goes. So to answer the question real succinctly, that concept, kind of rule of thumb of moving down based on your age, yeah, if you can, that's not a bad thing. If if you're at 40%, your plan says you could be at 20%, then you have the ability to move down, especially if your risk tolerance is already above 40, or at 40. Uh, then there's nothing wrong with that as far as that goes. But you have to look at it from a different standpoint. It's not just because of your age. You're trying to accomplish your goals. You're trying to identify who you are, and all of these different things fit into one piece. It's not that easy. It's not just some rule of thumb. Hey, I'm retiring. I'm going to reduce my risk. Um, and in the real world, and dealing, I've done 6,000 plus financial plans. I've dealt with thousands of households. Um, I've very rarely seen anybody move down, especially early in retirement. Maybe later. Some of my most aggressive clients are very old, 80s and 90s, because they have a very high risk tolerance, and they believe that the stock market is substantially better than the bond market, and that belief has created their wealth, and that's what they want to keep doing. So lots of other aspects come into play besides age.
Cool. So usually risk tolerance is kind of, you would say, doesn't change too much. Is there any events that kind of change that? Because I know probably me, when my like retirement accounts get up to like bigger values, I definitely have my tolerances coming down more and more, I
Yeah,
would say.
yeah,
Um, does
yeah.
that happen for clients? And then also when there's no more income, when you reach retirement, when you're not adding to it, does tolerance ever change them too?
I haven't seen tolerance change as much based on retirement and income needs as I have what you just mentioned, which is size. So you have a $5,000 IRA. You lose 50%. You're down $2,500. That's not great, but it's $2,500. There is a dollar amount that matters. You have a $500,000 IRA. You lose 50%. Now you're down 250,000. The number of years it takes to get that back is ridiculous. And so, yeah, size of account and size of wealth. Um, but it isn't a perfect scenario. It isn't a perfect correlation. I've had other clients who said just the opposite. Because I have more money, I can take more risk. I can afford more downturn. Hey, I have $5 million now. I only need 2 million to live off of. I can take more risk. Again, it comes back to your own personal risk tolerance and kind of what you're willing to deal with. But I have seen some people just a couple of places where I've seen people adjust their risk tolerance. I would say long term over the entire retirement, we do see some movement down in risk tolerance. Yep, and some movement down in stocks. But the question before, was 60-year-old looking at, retirement right away. Maybe not until they're 80 or something, where something would change. But the other aspect, of course, has to do with the size of the account. But here's the weird thing. I've actually seen risk tolerance go up. When the markets go up, people start to want more of that. So, hey, they got their stocks made 30%, their bonds made 2. And I want more of the 30. And so they go from 60 to 70%. Well, we try really hard to make sure people understand that they're increasing their risk and what that means. And so, we use a program called Riskalyze. It sends out an email every quarter that shows for their portfolio right now, the way it stands, if we had another big downturn, here's how much you'd lose, here's how long it would take to get back. And so it's just a constant reminder, which is what, and we didn't have these tools before 2008. And so, I haven't had as much movement up since we started using that program because people are realizing what they could lose, and they can settle in and kind of, if you could lose 15% and you lose 15%, you're probably okay. If you lose 40, you're going to maybe freak out. So, anyway, that I've seen more people move up and then they end up, kind of in trouble with than down actually. But yeah, and then we see small changes. Like before the election last year, everybody thought there was going to be all these problems. And there was, ironically. And so a few people moved down, from 60 to 50% or something along those lines. Of course, we had I think from the matter of fact, from the election itself to the inauguration, that was the greatest run in that history, going back to the 1900s. That was the best between election and inauguration run in the history of the stock market. So obviously it didn't work, getting more conservative, and we had all these problems and insurrection and all these things that happened, and yet the market still went up at least in that time frame. So that's why you got to be careful with those movements based on your thought process for what's going to happen. It almost always goes the other way. So find your risk tolerance, stick with that. Maybe make some changes within the portfolio. If you're going to be at 60%, stay at 60, but you can maybe change the aggressiveness of that 60 one way or another. So it's a good question. It's a topic of conversation pretty much constantly within the practice, and so it's worth covering here too. That's a good. Thank you for asking that.
Yeah, so another question that comes up a lot is it better to self-insure rather than having long-term care or long-term care insurance?
Yeah, this comes up a lot, because these people have money and they could afford insurance. They have other insurance. They have, health insurance and auto insurance and insurance on their home, and maybe they have earthquake insurance here, those type of things. And so they want to know if they should have long-term care insurance. And one of the things that is true is if you can afford it, yeah, and a lot of people do that. Hey, I have the money. I just want to sleep well and know I have it. Um, but we can test it to see if you need it. Um, and so there's a group of people that don't have any money that are going to be taken care of by these safety nets. And California is called Medi-Cal, and the rest of the nation is called Medicare. So when you're really at the lower end of income and assets, the government has facilities that they pay for. Um, and then you've got this other group at the upper side, right? For us, it's a $10 million of assets or something along those lines, for example, who could afford long-term care. And so but we can go in and test and we can say, okay, here's how much the premiums are. And here's what might be at a cost for you coming out for long-term care and figure out whether you really need it or not. And so, are you self insured or do you really need it? And so, there is this group kind of in between that has, assets, but not enough to really pay for long term care and not impact, let's say, the spouse that's still at home. That's one of the biggest issues that comes up. And oftentimes that those people really should have long-term care. So you got to go through that process of figuring that out. There is no blanket rule there because your situation is unique, but we can put that into the financial plan and analyze it and figure out whether it would work or not and what have you. But I will say something about long-term care insurance in general that you should understand. You can go to a casino and you can win in a variety of different games. You can win. People do win. But for the most part, you don't win. And that's why that casino is so fantastic, so elaborate. Insurance companies are the same way. They know exactly what is going to happen in terms of what they're charging you and what they're going to pay out. So long-term care insurance policies often have caps. So let's say it has a lifetime cap of 300,000. You might pay over your life $75,000 for that $300,000 policy. If you go into long-term care, it was a really good investment. You won. You went to the casino and you won. Now, you unfortunately had to go into long-term care to win, which is not a great win. But at least from a pure financial standpoint, you put in 75, you got out 300. But most people don't go into long-term care. And believe me, if they're charging you 75, it's because they rarely pay out more than that. And so that's the issue too. You got to think about that as far as that goes and how those odds work. Again, if you're in that scenario where you have money that you need to protect, especially if you're married and have a significant other that you want to protect, then maybe you should each have a long-term care insurance policy. If we run through the plan and it shows that you should have a long-term care insurance policy, um, that group should have a long-term care insurance policy. Now, there's a group above that with a lot more money that could afford it. If they want it, do it. But they might not need to. And so that's how you can answer that. Again, is inside, you run the Monte Carlo simulation, you show, okay, you go into long-term care for 4 years. I think the average is 3.7 right now, and that kind of thing. It's very expensive here. It can be up to 10,000, even more a month here. Cheaper in different areas. So it kind of depends on where you are as to how much that is. But we can model that and tell you whether you need it or not. That's a starting spot. If you need it, you should probably get it. If you don't need it, then you could get it if you want, right? But just understand kind of how it works.
Yeah, and so if you're thinking about long-term care insurance, the best times are usually in your late 50s and early 60s, or that time period to start targeting and thinking about it.
Yeah. Yeah, it's an interesting thing. We don't sell long-term care insurance, but I do end up dealing with it often uh, because I keep getting clients, telling me, hey, I bought this long-term care insurance policy and now they're raising the rates. And they can raise them quite substantially. Matter of fact, the last one that I analyzed was for a lady who had paid about 75,000 into it. Um, and so they were going to raise it a lot, like 50%. Now, and she happens to be in a situation health wise where there was some, need potentially coming. But they gave her some options in terms of, reducing the benefits to try to keep the premium, increase down to something reasonable. But yeah, it is, I'd say that's right. 50s and 60s is not a bad point to do it. You just have to be a little bit careful in terms of where you're at physically. The irony is for life insurance, man, if you have uh, high blood pressure, diabetes, previous cancer, those are all bad things. They're going to be really hard to get, life insurance. If you're looking at long-term care insurance, they're much more interested in your cognitive decline. And if you have cancer, they may not care as much because you might not end up in long-term care on an average basis as often. The real big cost for long-term care is cognitive decline. Dementia and Alzheimer's, certainly one of the faster growing areas. So that's why getting it in your 50s and 60s is usually a good idea also, because you probably aren't suffering from those at those ages much. But yeah, that's a good point.
Yeah, and it's important to have it if you need it because to qualify for Medicaid, you'd have to essentially liquidate all but $2,000 of your net worth. And so it's very like that's a safety net there for you, but the government's expecting you to use everything you have essentially. And
That's a
it changes slightly when you have a spouse and they're living in a household, but as a
that's
single person, you have to
that
eliminate a lot of your net worth.
Yeah, so I just last night I had an appointment and they asked about, the mother is back in another state outside of California and, has X amount of assets. And they were approached by somebody who was showing them how they could protect those assets and get the mother into a Medicaid facility, and, which wasn't so Medicaid. Certain facilities don't take Medicaid, so and certain do. Um, and so she wasn't in one that actually took it. So she would have had to move. And he was asking me about it. And I just told him, I said, look, I've done some pretty in depth analysis on every one of those schemes that I've ever seen. I have yet to see one that I would even remotely considering doing. It is possible. There are some things that can happen, but be really, really careful with that because you can get into a situation where you just don't want to be for a scenario that might not happen, because you never know. Even because his mother was in assisted living, doesn't mean she's going to go into long-term care, right? I mean, she could, but she could have a heart attack or different things like that could happen too. So I have yet to see anything, and I know this is going to fly in the face of some of these elder care attorneys who have these strategies. I just wouldn't do them. I've been through too many scenarios I've looked at. So, but that's just my personal opinion.
Yeah,
Oh,
because
go ahead.
when you do that, there's like the government has like a certain period of look back. And so any
Yeah.
gift is still considered part of your estate if it's in
Yeah.
that look back period. And so it could extend that time where you don't qualify for
Yeah.
Medicaid.
Hey, I'm going to give away all my money to my kids so that I can qualify for Medicaid or Medi-Cal. But then they have this look back period. And, they can look back 3 years, for example, in some cases. And so, you know, then you end up in long-term care. They're going after your kids for the money. It's just, that's why you want to look at it, at any point in time, you want to look at it from an analysis of do I need the policy? Do I not need the policy? Do I have the money? Do I not have the money? All of those aspects of trying to figure out how to take care of yourself instead of trying to get the government to do it. I've always said this too, if there is some strategy that does work, they keep closing those loopholes. Like here in California, they don't want to pay unless they have to. And it's great. I think it's a great safety net. It's exactly what it's supposed to be. You can't wheel these people out into the street. So, that I think that's perfect. But if there is a loophole, they keep closing them. And man, you got through all this work and hassle to try to get into this qualification, only to have it closed anyway. So that I discourage people from looking at that. Again, I know that there are people out there who think I'm wrong, but I haven't seen one yet that I would do personally. And I've looked at quite a few. I get approached, by clients with, these things too. So all right. Well, that's the end of our show. Another one. We got a 3-day weekend coming up here. That's exciting. Looking forward to that. Again, what we're trying to do here is help you make your retirement work better. Whether you're 20 or 80, it doesn't matter. It's still something, there's still something in what we're talking about that might be able to help you. I really appreciate, these are great questions, by the way. I really appreciate joining us today. And again, you can subscribe if you want to continue to see what we're putting on the channel, or send us your email address and we'll do that. But and of course, if you have something more complex you want to talk to us personally about, you go to our website and click on the book appointment and just schedule an appointment, 30-minute phone call or 30-minute video call. And we'll see if we can help you, personally. So I want to thank everybody for coming, and I'll see you next week. Thank you very much.